Hello everybody, welcome to today's session. In today's session, we're going to go over a risk management strategy known as hedging. For those that have been in the trading industry for a while, may have heard of it. For those that are new in the industry, maybe your first time hearing of it. This is the strategy that the no stop loss gang always use. So if that sounds interesting, please do stick with us until the end. You know the vibes. Don't forget to like this video, subscribe, and share with a few friends that you believe will find value in it. Now, we're going to start off with the very definition. Hedging, in simple terms, refers to the strategic use of offsetting positions in the market to reduce or eliminate risk with the adverse price movement. What does that mean? What this means is that, okay, so in front of us is obviously JPYX, but never mind it. We're going to do theory today. So what that means is that as traders, hedging is a strategy that most likely people that don't use stop loss use this. Now you, as a beginner, you're entering the market, you don't place a stop loss and you're like, yeah, I'm just gonna let it ride. Now, people that don't use stop losses also have a strategy to manage their risk. Risk management is everything. There are multiple ways of managing risk, but people only believe that stop loss is the way. But this is an alternative. So for instance, you see, okay, so let me add another zone or a couple of zones here. Okay, please bear with me. I'm about to drop some gems. Okay, so let's assume you're a trader. You took a position. You took a position here, a buy position, believing prices will be pushing until they reach maybe somewhere here, and then you close your target, right? But what happens? Prices, when they were coming down here, when they reached here, instead of starting to buy, they kept on selling. They broke this position, retested it, and then they're looking to actually keep on going lower. Now, for those that are traders, or for those that obviously that manage their risks by using stop loss, which I happen to be one of them, once prices reach here, I'll have been stopped out and I'll be looking for the next trade, whatever day. Maybe if I see prices of broken structure, give me a retest, I'll be looking to take a sell trade to swing with it until it reaches down here. But for hedge traders, it's different. You see this trade that they took a buy here. They were anticipating to see prices keep on pushing until it reaches up here. They're not going to close that buy. As a matter of fact, it won't be closed because they don't have a stop loss, right? So they're just going to let it ride. But once prices break below here and they give us a retest, for me, I'll be looking for another position because I'm already stopped out. But for a hedger, he'll be leaving this open position, this buy, he'll be leaving it an open position, and then he'll take a sell, the same position size as this one right here. So if maybe he took a sell, he took a buy here with 0.5 lot size, here he'll sell 0.5 lot size, right? Now, obviously, the reason why he doesn't close this is because he believes that in the long run, prices will favor his direction. And obviously, you have to be a pro at this. You obviously have to always be looking at the higher time frames to get your directional bias and all that. But once he has a buy here, he'll place a sell here, right? So prices, once they start selling, they start pushing, they reach maybe the next structure here, obviously we'll be taking orders off. For us that are using price action, we'll be closing our profits, booking our profits, we're good. Now for a hedger, he's having a, let's say, a 0.5 open lot size position with a sell and a 0.5 lot size position with a buy. The buy is a loss, the sell is a profit. Now, after it reaches here, he doesn't close against the sell, right? He looks at the momentum first. Is the momentum indicating that the sellers are out, or is it still indicating that they'll keep on pushing lower? Because remember, this buy is still on, so it's booking loss, it's booking a loss. The deeper it goes, the bigger the loss. Now he doesn't want to blow his account, so this buy or this sell order is covering this loss, right? Now he doesn't want to get out of the trade too early. Let's say if he closes a sell here and then the trade keeps on going lower, this will actually make him keep on losing money with this buy order up here. So he wants to make sure when he takes, or once he closes this sell order, it's right there that prices will start buying. So that's the reason he looks at the momentum. What's the momentum indicating? Is the prices indicating that the sellers are losing momentum, that the buyers will take over now? And then once maybe he realizes, okay, the sellers are losing momentum, we need to start looking for buying opportunities. He closes that sell order, books a profit. And then what he does is that he actually takes another buy from here to start moving with it, believing he'll maybe come back all the way until it comes up here and book a double profit. But the second reason for doing that is that he's taking another buy here in case prices come back here and then they form the trend or they change the trend and start selling. This buy here will actually cover this loss right here, right? So what does that mean? That means, okay, I took a sell here, I already booked it here, I already made my profit, right? Now, once these prices start selling or they start buying again, okay, so placing it up here is very fast. So let's assume it came back here to where this market structure was, obviously because prices move from structure to structure, right? So let's say this was the most recent low, prices came back here, retested this structure, and it looks as if they're going to start selling, right? So what he does is that he closes this buy order, and then he also closes this sell order, because he'll understand that the trend has changed and now prices will be looking to sell. But at the end of the day, will he have made a profit or will he have made a loss? Obviously, he'll have made a profit, because remember, he already took this sell and then he already made profit. And then he took another buy here, came back up with it, and then closed it here. So in this trade, so let's say this movement is about by 0.5 lot size that he's trading with. Let's say this is a $1,000 pip move. And this is about 3/4. And this right here, this loss here, it's about 1/4, obviously, because we bought on the support, right? Always buy on the market structure, guys, or sell on the market structure. Never trade by chasing a trade. Always trade on the market structures. So at the end of the day, he'll have made, let's say, $1,000 here. He'll have made $750 here, but he'll have lost this $250. So at the end of the day, he'll have booked $1,500 profit on a move that wasn't even his move to begin with, because he was anticipating to see a buy. But he took a hedge, sold it, and after selling it, prices once they reached here, he took another buy, hedging this buy, doubling down on this buy position. And then once he saw again it's losing momentum, changing structure, looking to go long, to go short, he closed all the positions, the sell and the buy, right? And then he overall booked profit. Man, that's a complicated risk management strategy, guys, but it's called hedging, and it's what most of the hedge funds out there are doing. Obviously, you guys have heard about hedge funds. Hedge funds out there, they're more popular in the US. Hedge funds are using hedge funds to trade stocks, but this is what they mostly do. They do hedging. That's why they're called hedge funds, right? And this is the risk management strategy that they use, most of them. And that's how you can actually do it. You look for a position. If you see prices are going against you, you take a position against yourself on the first order, same lot size, so that the loss can always be equal to the profit. And then once you see prices have reached a significant support structure and it has lost momentum, it has the possibility of reversing, you close the first order, right? You close the hedge. You close the hedge, and then you take a counter trend, or you double down on the position that you took. Like for instance, here it was a buy, you take another buy here, so that in case the structure that the most recent structure is retested and prices decide to actually go the opposite direction with you, you can actually close out both positions and still make double profits. So that's how risks managers on most of the hedge funds actually manage their risks. They take trades, no stop loss, but they actually hedge their trades. Now, if you are trading a prop firm, obviously hedging is not allowed, but if you're trading personal accounts, you can actually use hedging to your system. But at the end of the day, guys, it all comes down to the proper risk management. Never risk more than what you can't afford to lose. And before you actually start using this hedging system in your live accounts, I'd advise you to practice it on a demo until you perfect it. That's when you actually use it on a live account. And I'm not saying hedge funds or the people that are using hedge don't book losses. Of course they do book losses. There is no system out there that will teach you how to not book a loss. The only way that you can actually be a profitable trader is to minimize the losses and, make your winners bigger. So with that being said, guys, I appreciate you by watching so far. If you've been in this channel, I really appreciate you. Thank you for subscribing. We just hit 1,000 subs. I really appreciate you all. If you're still not subscribed yet, be sure to do so below and turn on that bell notification so that you won't miss out on future content. If you're not yet in our Telegram discussion group, you're missing out. The link is in the description. Be sure to check that out. With that being said, guys, I appreciate you all. Have a great week. Peace.